sells it to us petrol in rupees, petrol and kerosene in rupees. So if we have a imbalance or if dollar goes strong, then Indian Oil has to pay a lot more rupees to get a dollar. So Indian Oil suffers. For example, if $1 becomes 100 rupees, for example, and Indian Oil has suppose 1,000 rupees, so Indian Oil then only gets $10. So then Indian Oil can only buy $10 worth of crude oil from Dubai or wherever it's buying. Now, what Indian Oil does is it buys the crude, then it processes it, makes petroleum, naphtha, benzene, kerosene. A lot of products get made from crude oil, and then they sell it. So they sell kerosene at PDS stores. And of course airlines use kerosene as fuel. Then they sell petroleum and LPG and all the stuff, right? So, um, an increase or a weakening rupee hurts Indian Oil because they can't purchase more crude, and but it makes Narayan Murthy very happy because a weakening rupee means if a rupee becomes 100, if a dollar becomes 100 against a rupee, Narayan Murthy bills its engineers in the US in dollars. So they get paid like $20 an hour or $15 an hour. So if dollar becomes 100 rupees, then Narayan Murthy gets 1500 rupees for 1 hour or 2000 rupees for 1 hour, which is $20 per hour rate. But when Infosys had signed that contract, rupee was around 70 or 80 rupees against a dollar. So they were supposed to get for $20, they were supposed to get 1600 rupees. Now they are getting 2000 rupees. So they're getting 400 rupees extra. It's a classic example of when rupee becomes weak, then Infosys benefits and Indian Oil suffers. And when rupee becomes strong, then Infosys suffers and Indian Oil benefits. So having worked on both sides of dollar or rupee, I have this is very common what to say observation that I make about having been in an employee of both the companies, that dollar and derivatives help or hurt each other differently. Having said that, today's topic is derivatives and risk awareness, and derivatives are a risk management tool. So the intention of these derivatives is to ensure that none of these impact actually happens. So okay, let me load the file. The derivatives risk. Let me share the tab. Okay, so the impact here is that if the company has ensured that its exposure across fluctuation in currency is horizontal scaling, yeah. So if a company ensures that it's not exposed in a way that any currency volatility or any foreign exchange volatility impacts them, then that company can survive in a tough or volatile market. And what an opportune moment to talk about this when the world is passing through a very, what to say, volatile phase, right? So and every country is now going to fend for themselves. So with that as the background, we'll start today's session. We'll focus on derivatives and risk awareness. So first is Apollo versus MRF. Who carries FX risk and how do swaps and futures work, as well as a credit event, right? So what is FX risk identification? That means if the company needs foreign currency, for example, Indian Oil cannot purchase crude from Venezuela in rupees, because what will Venezuela do with rupee? If Venezuela wants to buy a MacBook, Venezuela needs dollars. So Indian Oil cannot buy crude, or BPCL or HPCL cannot buy crude oil in barter system, because the exports of India is gold, finished products like gold and refined oil and whatever, jewelry and software services. So India's exports do not match. What if Venezuela needs software? What if Venezuela needs diamond rings which merchants in Gujarat make, for example. Then India can barter. You give me crude oil, I'll give you polished diamonds, right? That doesn't happen. So then Indian Oil is a company which is exposed to FX uh, risk. It's exposed to FX risk. And then in today's session, we will see how company like Indian Oil can manage such FX risk. Let me bring it to the front, order, move to top, and let me move that to bottom, and make this a bit smaller. Yes, so that it stretches and renders well on YouTube for everyone. Huh? No, I think the full screen will be too big for YouTube. It won't be visible. So just for the benefit of everyone, for our audience as well as for you, I'll make this a bit smaller, and just give me a second. Scale this down. Uh, um, yes. And but why are our videos gone? Okay, we have to bring it to move to top. And where did our videos go? Our videos
I think our videos are just
overlapped by this thing, right? Yeah.
no, not overlap. Our video plans are actually just, I don't know, thumbnails of the PPT itself.
Yeah, so because we did resize our PPT, command C, command V, just to make it easier to look. So in that attempt, our videos are at the bottom right. So OBS does punish any change if someone turns off the video and goes away. That hits the entire OBS settings. So just one second, I just tried to maximize it so that the fonts become visible to you and people, so that it order move to top. Okay, it's now on top, and let's remove this. Yes, command C, command V, it's duplicated, and good. So we are back with our move to top, with our videos on top. Yes, so this is first is FX risk identification. This is a classic case of derivatives or financial risk management, and which companies always practice by identifying and declaring the risk in an annual report, which you can see, or they're measuring their exposure to different currencies, right? So we'll look into this and see which companies are exposed in this format to foreign exchange risk. Then what we'll do is we'll take a look at the forwards and futures. What are the remedial measures? How companies can lock into a particular rate, and what is that rate all about? Is my voice coming through okay?
Yeah.
Okay, thank you. So that is forwards and futures, and then how one is whether they can lock it, then how they can lock it. Then that is called, there is something called interest rate swaps, which is fixed versus floating conversions. We are only looking at FX risk. We are not looking at the underlying commodity risk. We can also look at commodity risk, and there we can have options and futures, calls and puts being written on the commodity as well. We can have a separate session on top of that. I recommend the book called John C. Hull. 7th edition is what I read. I think the new edition has come up. And in options, futures, and derivatives, commodities are the first things which are fluctuating in market, and options are written on top of that to have some kind of risk reduction on the volatility of the prices of the assets. For example, maize and corn. In India, electricity is another commodity on which derivatives are written. So you can buy and sell electricity in the electricity exchange at particular rates and prices. This is something that I am currently working on as a part of my work or interest in smart grids on how electricity can be sold and purchased. That's a separate discussion. So interest rate swaps come in that place where you have fixed versus floating conversion. Finally, you have hedging as credit signal. So if a company has hedged its exposure properly, and that should be signaling that company is very prudent in terms of managing its credit worthiness. So that any shocks in terms of changes in their FX market value or their current rate at which they have procured FX to pay their vendors or pay their raw material suppliers, that will change, right? With that as the fundamental, that's good. Here we will only use publicly available data. So, for example, Madras Rubber Foundation could buy, the rubber factory could buy rubber from the rubber plants in Kerala or some rubber trees in India, whereas Apollo could be buying rubber from Indonesia or Malaysia or some kind of an equatorial place where there is a lot of hot and humid environment where the rubber trees are very popular. Whatever is available for us, where they source the raw materials from, we'll take that information. For example, if MRF sources it from Indonesia and Indonesian currency versus Indian currency changes, depreciates or appreciates, whatever, then there is a risk, FX risk. But if the company buys directly from India, then rupee there is no risk, for example. So that is the inherent assumption. So first is the unhedged importer, a tire company which imports 40% of its raw material in dollars, and when rupee depreciates from 83 to 89 rupees, which is 7% depreciation, so if 15,000 crore worth of import, that is 900 crore of additional cost, and it's unhedged, so it gets deducted from EBITDA. So EBITDA margins straight away go from 14% to 8%. It's a huge fall, right? It's huge fall in terms of 40% fall, around 40% fall, yeah. And debt service coverage ratio literally becomes half, which shows that company is going to default, which is here. It becomes 0.66, right? So which shows that the company it cannot service its debt on time, all because of no fault of their. It's because the rubber prices have increased. If you have been noticing, the prices of coffee has increased. If you are a avid drinker of coffee or tea, and if you are Starbucks, for example, or if you're Cafe Coffee Day, or if you are any barista which makes coffee and you don't source coffee from India, suppose you don't source, I think the one which is in Kodagu, you don't source from there, you source from outside, like Arabica, Robusta, or some other examples from outside India, and then you only serve a cup of coffee for 250 rupees at your cafe. But if your price of coffee rises, then your margin falls immediately. So that's a classic case of commodity hedging, not the FX hedging. If you have limited amount of money to buy coffee, even if the dollar changes, dollar becomes weak, and the coffee price also increases. That's double whammy for you. So first is, you should, if you know that you have to purchase coffee in dollars, or you are buying it from say Amazon.com or Flipkart, you are buying coffee, you are making coffee, and then you are selling coffee, then you are okay. But in Flipkart, if the prices rise, what will you do? You can't ask people to pay more because they will leave your company, and it doesn't show you as a good brand that the moment your costs go up, you have to immediately increase the prices. You need to have some buffer. So so you have to do one thing, to summarize from here, is that one is commodity hedging. When you hedge the price of commodity in terms of volatility by buying either call or put, so that you can always buy commodity at a cheaper price, and then you ensure that the person who you have entered into such call or a put will be able to supply coffee. That, for example, if you purchase coffee at 800 rupees for 200 grams, and now the same 190 gram Nescafe bottle is 1300 rupees, which is from 800 rupees to 1300 rupees, at the 500 rupees increase. If you had signed, for example, subscription on Amazon that every month you get one coffee bottle at 800 rupees, then Amazon is bound to supply you at 800 rupees even if the market price is 1300 rupees. and you will see this as a common example everywhere. For example, you read a magazine. Suppose you read a Hindu Frontline, for example, and Hindu Frontline costs 100 rupees. So you purchase a 1200 rupees subscription for Frontline magazine. So that means if tomorrow the price of Frontline becomes 150, Hindu will not charge you 150 because you have purchased a subscription. So imagine call as a subscription to buy something at a fixed price for in future, and that future is what you decide at a particular price, right? So, but in this case you are not bound to purchase. You will only exercise that option when you um, feel the market price is higher. For example, if I give you the same Hindu Frontline example or Hindu Sports Star example magazine, suppose you read Hindu Frontline or Sports Star magazine every month. You like sports, so you go to the magazine stall and buy one magazine for 100 rupees. But you are worried that if the value of Sports Star becomes 200 rupees, you cannot afford it. So you strike a contract with Hindu as a group that you will always give me Sports Star at 100 rupees. Hindu says okay, but you say that you don't send it to me at home. Whenever I will ask you to give, you have to give me. Hindu says okay. So you never buy it, you never get it from Hindu. You always go to the stall, you buy it from 100 rupees. So today you went to stall, it's 150. You pick up the phone, call Hindu. Can you give it? Send it to me at 100. They will send it to you at 100. So you exercise that option as and when needed. That is called as a call option. Similarly, there's something called as put option. What is put option? Suppose you are a agriculture, you come from an agriculture family, you are farmer, and you produce 100 kilos of wheat every month, or 100 kilos of paddy every month. So you totally produce 1200 kilos of paddy in a year. So you know that the current price of paddy per kg is around say 30 rupees. So in every month you can get 3000 rupees for 100 kilos. So what, or say 50 rupees. So you get 5000 rupees per month for 100 kilos of paddy, right? So you go and strike a put option that you can always sell paddy for 50 rupees. So, but you are not bound to sell. You will, so for that guarantee, you will have to pay some rupee extra, like 3 rupees, 5 rupees you have to pay, but you will get an insurance that suppose you have 100 kilos of paddy, next month you had 100 kilos of paddy in February, you went, you sold for 50 rupees, you are happy. In March also you have 100 kilos of paddy, you go to the shop, shopkeeper only gives you 45 rupees. You say, no, I want 50 rupees. He'll say, no, we'll give you 45 only. Then you pick up the phone and you exercise that option. And you say that, no, I have an option to sell it at what happened? Okay, this went away. Did I lose you? Are you on mute?
No.
Acha, okay. Acha, okay. So suppose you go this month and try to. I'm just trying to explain the concept to you. Just elaborating for that perspective only. So you go to to market with 100 kilos of paddy, and you say, okay, last month in February I sold 50 rupees a kilo. I want to say I have brought 100 kilos of paddy again. Let me sell it for 550 rupees. Give me 5,000 rupees. They say, no, we'll give you only 45 rupees. But you say, no, I'll lose 500 rupees. I want 5,000 rupees. They say, no, but the current market price is 45 only. Then you pick up the phone and call the company with which you have signed a put option. You say, I exercise that put option to sell it at 50. The company will say, okay. The company will give you 50 rupees. They will purchase 100 kilos of paddy from you. So now you benefited that 500 rupees by paying just 5 rupees of insurance, right? But if you went to the market and you found that the current market price is 55 rupees, then you will not exercise that option. You sell it at 55. So that's how the put will benefit you. It will always ensure that you get certain value for your prices. This is kind of an insurance. That's kind of what we call it as a hedging. So what a lot of people do, they do not just buy a put, they do not just buy a call, they buy a put and call together. So they ensure that they make a V. There are many ways of making strategies. So what they do is that they always limit their downside, and they have an unlimited upside. so that they always have certain money that they'll give and infinite money more than that. Strike price is something, and then the set, which is S naught, which is can be strike price, and then the actual value can be anything. In um, in put call parity, or in options futures and derivatives, there's a concept of put call parity, and there's a formula which says that whenever the put call parity is broken, there is a place for arbitrage in the market. That means if P plus C into K e to the power minus R delta T, it's a formula which is C is the value of call, uh, plus K is that call price, plus e to the power minus R delta T, R is that risk free rate and delta T is the time, is equal to P plus S naught. P is the value of put and S naught is the strike price, right? Whenever the both sides of the equations are not balanced, we say that put call parity is violated. The moment put call parity is violated, you can make some money in the market. So you can go and see what's the put of Infosys, what is the call of Infosys at a particular rupee value, and then you can purchase put calls and puts, and you can trade in calls and puts. These calls and puts are derivatives of the asset. So if Infosys stock price is 5,000 rupees, the value of call will be 50 rupees, and that call will give you an option to buy it at a particular price. Similarly, put will give you an option to sell it at a particular price. So if you buy one call and one put, you can buy it at lower cost and sell it at a higher cost. You can then buy and sell and make some money. That is called arbitrage in the market, and that is called hedging. Right? There are more complex hedging frameworks, but bare minimum this is hedging. Right? So when you see an unhedged importer, it's rarely in any listed company you will see an unhedged company. But if there is an unhedged importer, then the moment the dollar price changes from 83 to 89, the price of import goes up by 900 crores, and EBITDA falls, because the moment cost increases, the profit falls. And then who gets hurt the most? The one who is in debt the most, because in debt you have to make EMI payments. The moment your cost of living goes up or your costs go up, then immediately your savings fall. This happens in true for all of us as humans as well. It's also true for companies as well. That's the unhedged importer. Scenario B is the floating rate borrower. The company takes 500 CR term loan at MIBOR, which is Mumbai, or LIBOR, which is London Interbank rate, and then you have 2.5%. And if MIBOR rises 200 basis point, which is 2%, over next 1.5 years, their annual interest cost jumps by 10 CR, just by plus minus 2.5%, which you multiply. If you see this one here, it annual cost jumps over by 10 CR. With this, with the interest coverage ratio of very low, even if the borrowing rate, for example, all of us would have taken education loan at a fixed rate, or MCLR plus some rate, which is marginal cost of lending rate plus 0.5 or plus 0.1%, whatever, right? If MCLR rises, then if the banks find it expensive to raise money, then our interest rates will also rise. But what we can say is that when we were students, you got that money and gave it to us. Now your price is rising, so why should we care? We should give you money at the rate at which you took. Suppose you took a loan in 2024, and you took a loan at a percentage, because the bank, suppose you took a loan from State Bank of India. State Bank of India borrowed 100 rupees from somewhere at, say, MCLR plus 0.5. Now it is MCLR plus 1. But they got that 100 rupees at 0.5. Now why should they charge you MCLR plus 1 at the current rate? They are not borrowing for you right now. But they will not listen to you. If you go to floating rate, that is a big problem. The floating rate changes, and it is unfair to people who borrowed it at a lower rate. So if you are borrowing it at a lower rate, you should always ask for a fixed rate. If you feel that the market in future is about to get more expensive, or the rates are going to rise, always go for fixed rate. If you see the market in future is going to be better, or the rates are going to fall, then borrow at a floating rate, and have those conversations with bank. If you have a floating rate loan, get another loan from second bank at a fixed rate, and you convert this floating into fixed. But that kind of visibility, usually individuals who do not have that kind of visibility and flexibility and awareness and bargaining power. But when you are in campus and you are borrowing for 600 students, if you are borrowing 40 lakhs for 600 students, that is 2400 24,000 lakhs. 240 crores is being bought. So 600 students of Narsim Monji will take 240 crore rupees. They'll pay 240 crore of fees in 2 years, which is 40 lakh approximately. So that's a huge amount. So in 240 crores, you can ask for 1%, 2% discount, and that will give you huge savings in the long run by either having a lower rate or having a fixed or a floating rate, for example. And this could be true for any college, not necessarily. I'm just giving an example. This can be true for IIT or IIM or whichever college you want to go to, right? So, but you got the idea, right? Fixed rate versus floating rate.
Yeah.
Perfect. So this is a floating rate borrower. So a lesser pricing of a fixed rate lease to this borrower gives them the natural hedge. But if you knew their liability profile, we need to know how much they have to pay if they already have other debts. Because if the floating rate floats and becomes high, the interest coverage ratio immediately falls. At higher interest rate, they will not be able to pay the interest. Either refinancing risk becomes higher because they do not have any assets to mortgage. If they do not have any assets to mortgage, then you will have trouble borrowing in future again, because everything you have is on lease. So then you need to have a covenant watch list here. You have to see covenant in that means as terms and conditions what you have mentioned in your agreement when you sign a particular loan. You have to be careful here. So this is the third is the hedge, which is a well hedged borrower, same tire company, but 70% of its FX exposure is covered with 6 months forward contracts. So it knows that whenever interest rates or whenever the exchange rates vary, within 6 months they will stabilize at suppose 85 rupees or 84 rupees per dollar, and INR moves to 89. The effective rate is still 84.5 because they have bought a hedge, they have bought an option, so they do not have to pay the increased prices. The unhedged 30% costs more, but the hit is bounded. So they may not be buying, they may not have purchased all the dollars at forward contracts. They may have purchased 50% of dollar or 30% of the dollar or 70% of the dollar, but they have reduced the hit by a very small, by a large amount. This is exactly like buying an insurance. The insurance premium is too low, but insurance is very big. So whenever you get a hit, the insurance premiums take care of it. So the hit is bounded and disclosed in the annual report. This is what good treasury management looks like. Treasury management is a paper that you can read. I took it in my college at IIM, and we can cover this in the future sessions. Treasury management comes from post hedging, and a lessor should reward this. So if you are providing financial credit line to such a company, you should reward a very well risk managed company by giving them good cheaper loans and longer tenure loans. The EBITDA, because this hedge protects the EBITDA, number one. uh, then EV by EBITDA and those ratios do not get skewed if there is any hit. DSCR becomes stable. Annual report footnote will have these kind of wordings here. Forward contracts worth $850 million. This is the notional value, not the actual value, at average rate of 84.5 rupees per dollar. Right. So then you have next is who carries more FX risk, Apollo or MRF? So Apollo tires carries significantly higher FX risk, both from the import and the export side, the debt size, foreign debt size. Why? Because 40 to 45% of raw material is imported, which is natural rubber and carbon black and whatever steel beads that they put on tire, they do not make in India. They do not manufacture in India. So whatever country, I think they get it from Malaysia or Indonesia or Singapore or wherever they get it from, that import and those countries will only ask for dollar. They will not accept rupee as a payment, right? So then these purchases are either euro dominated or USD dominated. To pay them in dollars and euros, Apollo India has to have so much euros and dollars in their kitty, and this causes they have to either buy it from RBI or they have to buy it from external free market. So the same foreign currency. So this is significant external commercial borrowings in dollars, 300 to 400 million dollars of outstanding, and rising dollar is higher INR repayment cost. That's first part. The foreign currency debt is high for Apollo. Apollo has manufacturing in Netherlands. Apollo Redress something. Revenue in Europe,
yeah,
uh, cost in Europe, but INR reporting means translation risk. So when they go and list and they declare their results in India for the transactions, they would have this higher risk in terms of translation risk here. Next is a revenue hedge. So 30% of the revenue are exports, which is Europe and Africa. So if dollar goes up or dollar becomes strong and compared to rupee, and the costs rise, they will be able to pass it to Europe and Africa, given the economies of Europe and Africa can absorb higher priced tires, or they are still paying to them in dollars. Europe, anyway, I think euro is a pretty stronger currency than currently than dollars. But Africa, I'm not so sure. Some countries in Africa there are. So then those revenues will support them because they are paying, they are buying raw material in dollars, they are getting money in dollars. Natural hedge on that
yeah,
portion, but insufficient to cover import plus exposure. So that is revenue hedge is partial. So net FX position is they need to have, they're long on USD. So costs in dollars are more than the revenue in dollars. So weaker INR hurts Apollo, and it's a credit risk. So if a bank has given a loan to Apollo, the moment rupee weakens, currently rupee has become 92 rupees or something. It is a big risk for Apollo because now Apollo has to repay back in a, or declare their debt at a very higher rupee value. MRF, anyway, we know that they have lesser import number. They have only 30% compared to 45% raw materials imported. They are in a similar commodity basket but smaller quantum, so lower revenue scale in export. So they import less, and whatever they make in India, they sell in India. MRF tires. MRF operates almost entirely on domestic borrowings or no borrowings. They do not have any debt. That means
yes,
they are not exposed to any dollar variation, or they are not serving a lot of external customers who will default if the dollar goes up or dollar goes down. So um, you make in India, you sell in India. Domestic revenue focus, 85% revenue comes from India, no significant overseas manufacturing. So translation risk is near zero for MRF, and they have a very conservative treasury. They are an Indian company, so Indian company will have very conservative management of their finances. They hedge their raw material import, whatever 30% they do, with forwards, and they disclose it in notes. So they are modest in long but no liabilities. That is for MRF. And Apollo's treasury problem, they have $500 million to pay in 6 months, and if rupee, God forbid, goes to 95 per rupees per dollar, or even 100 rupees per dollar, if the current situation goes bad, then this is a huge number. $500 million, $1 billion is at 100 rupees is 10,000 crore rupees. So this is 5,000 crore rupees payable in 6 months. So now they are stuck. How do they pay 5,000 crore in 6 months? Or if it is 92 rupees, it's 4,600 crore rupees in 6 months. So whatever, they have to pay around 900 crore or 850 crores per month, only in the this what the exposure they have, right? So forward contract can help them. So what Apollo can do, Apollo can agree with the bank to buy its all debt at $84.5, 84.5 rupees. No bank will buy it because the current market value is 92 rupees. Why will someone buy it at 84? But if they will sell it, if bank feels that the rupee will become strong, from 92 it will come down to 80, then bank will sell it to them at 84, because bank will make money when the rupee becomes stronger, right? So
yeah,
then Apollo pays this much for this much, and they have the what is the monkey is now off their back. But what that becomes is, if in future, this is old data, if INR weakens to suppose $95, 95 rupees, Apollo still pays 84. So they still save 10 rupees, or 10 rupees 50 paisa. If
yeah,
INR strengthens to 81 rupees, Apollo still pays 84.5 and saves 3.5 rupees. So the point is, if you feel that Indian currency is going to weaken, and why will Indian currency weaken? Just to give you a macroeconomic scenario, if India doesn't export something, number one. Number two, if whatever India exports is not needed by the market. So if India exports software programmers through Infosys and Wipro and TCS and whatsoever, and world has AI, they don't need engineers of Infosys or Wipro or any software services for that matter, then India's exports fall because companies say, "Yeah, we will use our own Claude and ChatGPT and Gemini and Copilot and whatever." So then that's a big shock to Indian macroeconomic scenario. So that will cause weakening of rupee. That means rupee will keep on rising because India is not providing to the world what the world needs, right? So then that's the cause here. So so what Apollo has to do is that they have to have a fully customizable size and date, no upfront premium, and a certainty of cost because CFO loves this certainty of cost. That's what they have to pay. Obligatory. The problem is they're obligatory. They cannot leave this. Suppose they point to wind up their operations in India. They do not want to have any further operations in Apollo India. They still have to pay this much money if they get into forward contract. Um, they are not traded in exchange, so there's a counterparty risk. If the other party violates or they default, a forward contract is between two people. It's not traded at a Bombay Stock Exchange, so you cannot go ahead and sell it to third person. And bank's credit line gets hit. So forward contracts appear as contingent liabilities. They will appear on balance sheet in footnotes, and large notional values are monitored. Other option is to buy futures, currency futures. Derivatives are very risky options. Sometimes there are some very well known people have called derivatives as weapons of mass destruction because if they are not handled properly, they can ruin a company. Derivatives management itself is a full blown risk management headache. So, but if you still want to play with fire and you want to buy currency futures, that means you are betting on how a country's economy will do in the coming years. You are more than welcome to play with fire. In that case, Apollo can short the USD. So whenever you short USD, you expect that the USD to fall. Nobody in their sane mind ever shorts USD because America is the global superpower and dollar never falls. You're always in a long position in dollar. But here, suppose Apollo shorts USD, the contract size is $1,000. They have a standard maturity date, and you can decide it's an American option or a European option. And then the future profits offset the import cost. If then dollar rises, so USD INR, the rupee weakens, dollar strengthens, then it saves the P&L cost, and the dollar weakens. Then then their margin calls, and Apollo must post more collateral to the bank to ensure that their contracts stay. These calls and options, they have a margin money also associated with that. That margin call happens whenever the calls that they have made, they want to hold or they want to exercise those calls whenever it hits a particular threshold. uh, Beauty of this is they are exchange traded, so there is no counterparty risk. The moment they feel that they are in trouble, they can sell it and move on. Highly liquid, so they can exit. The pricing is transparent, everyone can see. The bad part about this is if MRF or other companies know that what Apollo is doing, they can take an absolutely opposite position against them and bankrupt their competitors by deliberately bidding against their whatever options they are purchasing. Standardized size, imperfect hedge, daily margin calls happen, they cannot perfectly match invoice dates. Third option, of course, currency futures are marked to market daily, so every day you have to post a margin call. Whatever dollar or rupee transaction changes happen, they have to pay the premium or they exercise the options daily. Currency options, the premium is paid, they are rights but not obligation, which I mentioned to you. That you have a right to sell your paddy, your any product that you make, but it's not an obligation to sell it to you. These are the most friendly way to handle it. The purple one, which are the options, which gives you flexibility to sell, which is a right to sell, but not an obligation to sell. So then the best part is Apollo buys a call option. Safest place. You have a right to buy dollar at this value. The premium is paid upfront. If rupee weakens, Apollo can still exercise that value. If rupee strengthens, Apollo lets it lapse and benefits from better rate. So if you go and get better prices for paddy in the market, you don't exercise that option. But to keep that option as an insurance with you. So if on the weekends Apollo exercises at $84 rupees, Apollo can buy so many dollars at 84 rupees, use that dollars to pay their raw material cost, which is rubber. If INR strengthens, Apollo still has they have 84 rupees cost, so they can buy it from the open market actually and then pay. um, 81 rupees and then buy something. Downside is protected. Upside, you can take as much, uh, you can buy as much as you want. Useful for certain cash flows when the cash flows are uncertain, because uncertain cash flows means useful for your customers who are not commercially strong. So you feel that there is interparty risk that if the price of your product is expensive, your customers won't be able to pay. That is the example of uncertain cash flow in this case. And of course, if there are any operational cost in particular currency, then that currency value change will cause the operation to happen in a different manner. For example, if you buy something from Malaysia and your factory is in say Sri Lanka, and you sell it in India, there are companies who do that. So they take raw materials from Malaysia. Their factory is in China because it's cheaper to manufacture in China. So they take raw materials, send it to China, make it, and from China it comes from shipped to India. They do not take from Malaysia, bring it to India, because making in India is expensive. For example, so in that case, what I'm saying, what mentioning here is uncertain cash flow is because you send it to China, the Chinese currency depreciates. Your operational cost, your plant cost, your salaries to Chinese workers is in Chinese currency. Your raw material is in Malaysian currency. Your final revenue is in rupee. So that kind of
Yeah.
exposure has multiple currency exposure. So cash flows are uncertain. So this is very useful when there are uncertain cash flows because of currency exposure, and there is no obligation anyway. The premium cost is around 1 to 3%, so it's very cheap to exercise and use. They're more complex pricing. This is what I had mentioned before: Black-Scholes equation, bit of physics and thermodynamics here. One of my favorite equations which I studied. It's called Black-Scholes options pricing model. It's very math heavy. That's where quantitative finance and quant trading comes from. If you like a bit of math, do read up on Black-Scholes and how you value call and put, and how implied volatility gets calculated, and all the risk-free rate and delta t, the time and everything. Then option premium, any money that you pay for option is a cost. So you can subtract that from your you can put that in your expenses, because you anyway spending it annually or whatever. So you can uh, put that in your P&L, and your costs come down. EBITDA gets hit a little bit, but it's very small, 1% or 2%. It's very small. It's like buying a health insurance or buying a car insurance. It's like 100 rupees or 500 rupees a month. It's nothing. It doesn't impact your total income, but it gives you 1 crore rupees of health insurance. Imagine having to pay 50,000 rupees from your money for your health insurance, God forbid if you fall sick, right? So that's so it's beautiful, even if the P&L cost is real, but it's small. Lesser check, option premium show up as hedging costs in P&L. Hedging costs are usually very small if they're hedged properly. High option spend, either smart treasury or high uncertainty. So if there's high uncertainty, then you spend a bit more on options, buy different kind of options to get better hedge. So what is interest rate swap? The most common corporate derivative. Interest rate swap is an exchange for fixed interest obligation for a exchanges a fixed interest obligation for a floating one, which is, now we are talking not about the currency. We're talking about the interest rate. So if they have purchased at 2.5% MIBOR plus 2.5 or LIBOR plus 2.5, whatever that they have purchased from, why do companies use IRS? So they can pay whatever 2.5 plus whatever to bank and IRS, and they receive MIBOR. What bank and IRS desks do, they do Apollo post swap. They pay fixed 8.5%, receives MIBOR, net cost is 8.5% fixed. And so if they say that if MIBOR goes above 6%, you still get it at 8.5%. We will absorb any cost above 6 plus 2.5 is 8.5. We absorb anything above that. So now it's like you say that if I've taken an education loan at MCLR plus something, you actually go and take another loan from another bank and you don't use that money. You tell them whenever the interest rate changes, you pay me the delta of the interest, so that my exposure remains the same. That is what is called interest rate swap, and you have to pay some money to buy that kind of insurance, and you can lock in cost uncertainty. So what a company with floating rate to fixed when the rates are expected to rise. So one option is that you have taken a floating loan for a study loan. You can go back and take another loan for fixed, but then what if the market improves and you have taken, suppose you have taken MCLR plus 1%, and so your current education loan is at 11%. You feel it's too high. You take an education loan at suppose 10%. You say, now I'm safe. I've got a cheaper loan. What if tomorrow the rates become 9%? Now you are stuck with 10% for 5 years or 10 years or whatever. So what you can do is that you can, instead of taking another loan, you keep that loan, you buy interest rate swap. So you can always ask for a lower interest rate without impacting the main loan, because the interest payments get cancelled. That is called as interest rate swap. Of course, it needs a bit of asset liability matching, which means that a leasing company can earn a fixed rental but has a floating rate borrowing liabilities, so which ensures that if the interest rates are low, your rentals are high enough. A leasing company, the company can pay a fixed value and receive floating swap. They align the two sides, eliminating the interest rate mismatch. What does this mean? You can pay a fixed value and receive a floating swap, which means that if you are able to price the value of the asset in a fixed manner and then pay a fixed value, and then you have unlimited upside if the interest rate goes down. So that eliminates any interest rate mismatch. Finally, you need to have some regulatory and covenant management, that some loan covenant require a minimum fixed rate coverage ratio. They require, it cannot fall below something, it cannot fall below their cost of capital. A company sometimes just swap to purely satisfy the covenant definition, so that it's economically suboptimal. So companies, they say that of course it cannot be more than suppose 5 or 10, 15%. Some you cannot buy at 40% because company will default at that high percent. So those kind of clauses are there. These are like force majeure clauses, like companies have exercised force majeure when the war happens or act of God happens, but these are only to cover those examples that in an act of God you don't become bankrupt. Next is where to look at an annual report, schedule of derivative, treasury policy, and sensitivity analysis, and MD&A. MD&A is management disclosure analysis. If suppose company hedges 70% of the FX exposure, as an analyst you can mark in your notebook it is a positive sign. You can reward them with better leasing rates. You can accept standard covenant. You can, whatever you offer them, they will accept, and you can give them longer tenure loans. If they do not disclose any derivatives and they have major aspects, you can spot this. You can ask them before you are leasing something, that where do you get your raw materials from, how much, because I cannot see any foreign exchange reserves in your balance sheet or in your annual report. Do you buy foreign exchange as and when you need to pay? Then how will you buy it? You do not have sufficient cash reserves to buy foreign exchange if the foreign exchange becomes expensive, right? So all these questions before you lease something to them becomes very essential. That ensures that your lease is secure. So these are red flags. Next red flag is large speculative derivative, where the notional is much greater than exposure. That means the company is using derivatives for trading. If the company has an exposure of 100 rupees, they should only buy derivatives to secure that 100 rupees. If they have a derivative, suppose if you have a loan of 40 lakh rupees for the study loan, you should only secure yourself that if anything happens to you, you can pay 40 lakh rupees from your money, either from fixed deposit or from some kind of money coming in from you. If you are you are from calls and puts or some kind of an insurance, if you have an exposure which is 10 or 5 times your liability, this shows that you are trying to gamble with that money. So this is what it means, that it's using derivatives for trading and not hedging. This is an off balance sheet hedge, which shows that company is doing something else. So there have been a couple of big scams in India. First scam was ILFS scam, which you would have heard in news recently, and second was DHFL scam. These derivative losses can overwhelm operating P&L because they have written such huge derivatives. The price, it's like suppose you can buy a health insurance of suppose 1 crore rupees. You don't need a health insurance of 100 crore rupees, because 100 crore rupees is not a hospital bill for anyone. So, but what if you go and buy 100 crore rupees worth of health insurance? It sounds ridiculous. That's what they did. They purchased insurance which was way higher than their liability and exposure was. So the premiums bankrupted them. The premiums are so high that they couldn't pay their premiums on time. Then the companies discloses the hedge ratio, but it is declining, which means that the speculative view on FX, which shows that ask CFO about a treasury policy in a due diligence call. A large IRS books paying fixed on floating loans, positive. That means they are converting their floating loans to fixed value, which shows that the CFO is aware. Finally, company has a natural hedge. What is a natural hedge? That means export and import in the same currency. So if Apollo Tyres purchases raw metal like rubber from Malaysia and sells to Malaysia and has a 10-year contract that they have a monopoly in Malaysia, then they are just coming to India to manufacture it. Or suppose they don't even manufacture in India, they make in Malaysia, they sell it Malaysia. There are Indian companies, right? For example, Infosys, for example. What is an example of a natural hedge for Infosys? Infosys hires Sri Lankans to work for Sri Lankan companies. So Infosys gets paid in Sri Lankan rupees. Infosys pays salary in Sri Lankan rupees. So there is no exchange risk. So Infosys hires people in Brazil and Infosys gets a contract in Brazil. So Infosys gets payment in Brazilian currency and then pays in Brazilian currency. Doesn't matter whatever happens in dollars. That is the example of natural hedge. So understand, for this you need to understand the business model. How do they work? Where do they work? For example, if you remember when Apple prices increased, or when the America said that iPhone has to be made in America. So Apple did was they have a factory in Bangalore, in Devanahalli, and I think they have one more factory in somewhere in Osur in Tamil Nadu. What they did was they shipped planes full of iPhones from Bangalore and Chennai to US because it is cheaper to make in India. So they made natural hedge was to make in India, sell in India. But what if Indians will not purchase? So they made in India, sold it in the US. So they made some quick money by doing this. Finally, what do you do? So this is an in-class simulation. Apollo's treasury decision. Apollo needs to pay 300 million for raw material in 6 months, which is 3,000 crore rupees. Spot rate is not 84, it's 92 rupees. What should our treasury do? Option 1, do nothing, risky, because this becomes 100 rupees, so you will default, you don't have that kind of...
Spot rate versus the exchange rate
Currently on market, if you go and buy, so suppose I have to pay you $300 and you only accept dollars from me. I say, Nawal, you give me dollars only. So what I'll do, I have to pay Prashant dollars. I'll go, where can I buy dollars?
Around 92, right? That's why
yeah. So this is a hypothetical scenario where it is 84. Currently it is 92. So spot rate, if you put it...
I thought maybe there's some adjustment regarding...
No.
I don't know, maybe they deliberately keep it 84 spot rate.
No. So this 84 is an example. If it is 84, then what they should do. If it is 92, then what they should do. It's the same thing. So if the current spot rate is, for example, 92 rupees, what should treasury do? If they do nothing, then the rupee becomes stronger, very good. Then they have to pay less money. If the rupee becomes 85, 89 rupees, they're very good. If the rupee becomes weak, then they are exposed. Recommended is they have a forward contract, which they go and sign a forward contract with Central Bank of India, Punjab National Bank, or whatever, and from them they buy dollars. They don't buy dollars from market, they buy dollars. They say to Punjab National Bank that we will buy 300 million worth of dollars from you, but at this price, or 92 rupees, 91 rupees, whatever, at current price. If they expect rupee to weaken, if they want that if I go and buy it from Punjab National Bank tomorrow, it will be 93 rupees. Then let us buy today. If we think that this war will end, the rupee will become 92, it will come back to 90, then I will not standard. Then I will buy a flexible. I will buy a call option. I'll ask them to write me a call option of $300 million to sell me a USD at suppose 92 rupees or 84 rupees or whatever, and then I may not use it. Right? Similarly, if Malaysia wants me to pay for the dollar for my rubber, I can tell them I'll pay it to you 6 months down the line if they agree. And then by that time the dollar has weakened, then you can pay in dollars. So you can play around with that. You don't have to pay immediately when the dollar is very strong. But if your people who are supplying you rubber, they are not that financially well off, they need money to survive, then you have to pay immediately. Or if your business rules may mandate that you have to supply every quarter or every week, otherwise they will not supply, then you have to do this. If you remember, Apollo has also given a lot of advances to all the centers across India, and for that also they would have used their own cash reserve. The cash reserve comes in dollars. They would have purchased dollars long ago, and now their advances to different dealership is going to hurt them. So what is derivatives and credit memo? If you when you become a financial analyst or BD analyst, what will you write? you will find this is an example of a memo that you will generate for your company, for Apollo. If Apollo is your client, the Apollo imports 40% of raw material. This is common sense. There's nothing rocket science here. You can say that, hey, Apollo gets a lot of raw material in USD or euro. They have annually they purchase around 900 million or billion dollars worth of raw material, and rupee is depreciating at 5%. So if rupee depreciates and they have to buy only from countries like Malaysia and others who only accept dollars or euro, then they are exposed to rupee dollar depreciation. Either Apollo, you are not a CEO of Apollo, but if you are a management consultant, then your voice will be different. I have been management consultant for long, so if I am management consultant, I will tell them my voice will be that Apollo should consider buying raw materials from countries which accept rupee, or which are not natural trading partners with India. So suppose Philippines buys a lot of stuff from India, and Philippines also makes rubber, for example. So let's not buy from Malaysia, let's buy from Philippines. And then ask Philippines, can you take rupee from me? Philippines say, what will I do with rupee? You'll say, you buy services from Narayan Murthy, talk to Infosys, can they accept payments in rupees? Because Narayan Murthy pays its employees in rupees. So you pay them in rupee, he pays in rupee, but then that will erode, because if Infosys is playing on the dollar rupee conversion rate, then they will say, no, 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 we want dollar only. So you need to also convince. If you need to also have another arm within India who is willing to accept that rupee. So you give them rupee, that rupee comes back to you. That's how the money works, right? It goes in cycles. So that's a management consultant's view. But your view is that if they have $1 billion worth of dollars or euros to be paid, and that's only place they source raw materials from, so any depreciation of currency will hurt them. Number one. Number two, I have gone through the annual report. I did not find any hedging policy. So I feel we should not sign a leasing contract with Apollo, if because number one, they already have huge loans. They are not hedging. Lot of imports are coming from 70% imports are coming. Remaining 30% are unhedged. Then they have foreign currency debt. They have huge ECB outstanding. They have repayment schedules. 80 million, 800 crore rupees is due immediately, and INR is weakening. Interest rate risk is there. All the loans have floating rates. If the floating rates become higher, they will not be able to pay the interest payments. Finally, whosoever they are paying, there are drivers of Mercedes Benz or BMW or Audi. People are not buying BMW, Mercedes, and Audi currently. For example, I'm just giving an example. People are buying, but if Apollo only sells to those people, then the moment Audi and BMW and Mercedes do not put these Apollo tires in factory on their cars, suppose they put Continental tires, or suppose they put any other Goodyear tires or Yokohama Blue Earth tires, for example, then they are stuck, because then they do not have OEM tie-ups. This you have to call them and ask that, have you tied up with Maruti Suzuki that all Maruti Suzuki cars will have Apollo tires in factory, right? They have. If they do not tell you, you can sign a confidentiality agreement with them. You can say, I am analyzing you, I need that data, and give that data. Or you can read the annual news article that they have signed any agreement with those OEM manufacturers. In that case, you have a stress test here, which is in red here. This should be in a part of your memo that you write to your manager, and you mention that the scenario is this: MIBOR is so much, is unhedged, impact is this much, so it does not look a good candidate for us to even lease. Forget about lending.
Okay, so sir, this is strictly based on the sensitivity analysis that we performed, right?
Yes, and whatever data we will have on the annual report, both.
Uh-huh. So, for this exercise that we were doing today, I took Sun Pharma because I thought maybe a company that's exporting its commodities strictly to the US market, maybe that would.
That will look,
Uh,
doesn't matter. Companies does
so
not
in
matter.
that, there was actually a clause on sensitivity. They said for if the INR were to strengthen or weaken, let's say by 5%, then the impact on profit is so also, and the impact on equity is so also.
Hmm.
So that data was given. So
Huh.
whatever memo that we'll be writing to our manager is going to be based on just this assumption alone, right?
No, no,
Or
no,
are we
no,
taking
no.
any other
That,
process
that
for
that
this?
is your, so that is their assumption, or that is their forward-looking statement of where the currency can go. and the annual report was published 7 8 months ago. So you have to take current scenario. In current scenario, you have to look at the volatility in past 7 months or past 7 weeks, 7 days, and you have to generate a future set of scenarios based on new volatility levels. And then you have to create that in Excel or spreadsheet or Python or whichever language you want to, and then generate those new thresholds for volatility, and then
Okay,
create those scenarios.
just a very abstract idea from the
Hmm.
quote unquote.
Yeah.
I'm asking, okay, I mean, what's the best place to start and how should I go about it?
So for
Like a
example,
very basic roadmap.
yeah. So for example, I'm sticking with Apollo because I want to do complete analysis deep down on both these two. Sun Pharma has been a client of mine, so I know pretty well about what they do and how they manufacture and what the business risk is. I will not comment on pharma sector because it will go completely in different direction. It requires a lot of time, to be very honest with you. Um,
Yeah.
but that could be any sector, any company. Your analysis should always start with costs and cost management and what factors impact the cost. Here, the debt interest payments impact the cost, right? And the interest payment, volume of payment, and the variability and volatility of payment impact the cost. So the two things, the magnitude and the volatility. That's where you start thinking from. So that means because the magnitude will change if the currency weakens, volatility will come if the interest rate changes,
Ah, okay.
right? So what if there's a perfect storm that rupee becomes 95 rupees per dollar, and the interest rate also LIBOR or MIBOR plus is fine, but MIBOR goes up, then they are stuck. So create scenarios because both will happen together, right? Or suppose US economy falls, that's rarely ever happen, then the MIBOR falls, and then but the US currency rises. That's stagflation. So create such scenarios, and then for those scenarios you have to understand what the impact on cost. All that you're trying to do is to understand whether the company's costs are rising faster than the revenues. If the revenues are rising faster than the cost, then you're good enough. Then you're happy. If
Okay.
revenue rise faster
Okay.
than the cost, you have profitability.
Okay.
That's where you start your analysis from. And then we look at what are the different risks the companies carry in terms of their costs,
Okay.
right? So it comes from annual report notes, MD&A section, which is management disclosure and analysis. They have schedule of borrowing. Sometimes they attach it here, or you can ask a copy of this from their CFO. Sensitivity. This is what you have to do. You cannot take their analysis on sensitivity because they'll always try to show that all the risks are covered. Um, and the quarterly filings from SEBI. Whenever they have any risk or any kind of material risk to the operations in of company, which is material risk as defined or as identified in the annual report, they disclose it to SEBI. So that is something that they file regularly. So you have to look at that as well, and those impact your because of course this is a one-time investment decision in leasing and something. So you have to take it very carefully, and then you have to sign some covenants to ensure that the behavior stays similarly. So Apollo Tires, if you summarize, high FX, moderate, high foreign currency debt, zero. Very low derivatives activity, both are, it's very active. It's common sense because they're high, they have to take a lot of derivatives purchase here. The point of taking a lot of derivatives is that you lose a lot of money in the payments for the premium. Here there's nothing, so they save money. If you are physically fit, you don't need to buy expensive health insurances. So if you're financially fit, you don't need to buy a lot of derivatives. So if MRF is financially fit, they're still buying derivatives and they're wasting their money. They can buy a little bit of derivative, just cover their exposure and then stay here. The long USD, this is going to be an impactful for them because the currency is Indian currency is weakening and the dollar is strengthening here. So treasury sophistication, this is plastic poster baby for treasury management because of any multinational company um, which has different foreign currencies being used in the entire value chain, right from raw material to finished products, which is the customers. They have a treasury management coming in if there are multiple currency involved. Debt service coverage ratio impact is high. Any FX shock can trigger this value to come down, and the covenants need to be made in such a way. They have to have a stricter covenants. For example, in student loans can be that you need to have your father as a guarantor. You need to mortgage your house. For other people, they say, "Yeah, I will not pay. We don't need any mortgage. We don't need any co-borrower. It's just fine. One person is fine." For example, these are examples of a loose, kinder or nicer covenants. Those nicer covenants will be given to MRF. The Apollo, they will ask for everything to be hypothecated. You have to be very. This is not because someone is nasty at you. It's just that they feel that you are a risky investment, so they want to cover all their bases. So they have to have stronger risk management kicking in. That's where the covenants literally ruin any debt deal. You need to be very careful when handling with covenants, but you need to have those built in, baked into the system. So derivatives are off balance sheet risk, but very real. Very lot of companies do not, or analysts who do not understand what is an off balance sheet risk. They only look at balance sheet and annual income statement. They miss that part. A company with a strong DSCR and no FX hedge is one move away from covenant breach. So you look at balance sheet, you look at annual income statement, but you also go and read the report properly. You understand the business. Sun Pharma, do they sell a lot of their medicines to Americans? Are they selling medicines for cancer, diabetes, schizophrenia? I don't know. What kind of countries they're selling the most to, where their money is coming from, or are they just making malaria vaccine, or they're making some kind of hepatitis treatment, or something, right? So those you need to understand the business. Then you understand where they're getting the raw material from, what are the APIs and formulations which come in here. So are some of their formulations going, the patents are going to expire? For example, GLP-1 patents are going to expire on 20th of March, after which all the GLP-1 drugs will become cheaper. So diabetics which are currently have to purchase 8-9,000 rupees worth of medicine, you'll be able to buy medicine at 3,000 rupees. Those companies can now make a generic copy of the expensive ones after 20th March without violating any um, um, antitrust rules or any copycat or whatever patent infringement here. So you have to understand whether Sun Pharma has enough patents on those and any more molecules in the pipeline to ensure. We can go much deeper, but we'll not go into industry here. But that is derivatives are off balance sheet risk. Three instruments. There are three use cases here. Forward is certainty of cost, no optionality. Futures are mark to market daily. Then you have options. Options you pay premium and they give you right, but not um, liability that you have to do something. The best part is IRS. You do not have to pay back or take another loan for fixed. You just convert the floating risk to fixed just by purchasing IRS options or IRS securities. And the discipline of matching asset to liability duration is important. That if you have purchased a 15-year education loan at MCLR plus 1%, you buy a 15-year IRS at particular interest rate so that it becomes fixed rate. So then it balances out. So suppose you buy 15 years something at MCLR minus 1%. So it minus 1 plus 1, it becomes MCLR. That's how you create a natural hedge. Uh, then Apollo has high risk. MRF doesn't need money, but so it's manageable risk. Finally, the role here, as you focus in BD, is to read the derivative notes before approving a deal. You need to look for notional values of hedges, hedge ratio. A lot of BD people will not do this. BD people will send this to the back office teams, and back office team will take a lot of time to approve and send you some notes before they give you go ahead. This is called due diligence or risk management. But it's good if even a BD person understands the basics of leasing and how this works, right? So with this, let's go back to your tab, and let me put this on full screen, and let's look at what Sun Pharma looks like. We have gone and done this for, I guess, Apollo. Let's look what the Sun Pharma looks like. Take us through the Sun Pharma case and what you have found in Sun Pharma.
Sure. So, first thing I noticed was that directly to the column. So if you look at
It's there.
I-35,
I'll move the cells. Let me know. I'm sharing the full screen on the full image of the sheet on the screen. Tell me which cell you are focusing on, or if you are
I-35.
okay.
Yeah. So it basically says that they have for the just for the purpose of accounting, they have a couple of different hedging techniques. One is fair value, one is cash flow hedges, and net investment hedges. Sorry, net investment hedges. So these three, and they've described them in detail. So that's there. And most importantly, if you look at J98,
J98. Okay.
yeah,
1 second. J98 is coming up. Yeah, got it. It's now on
so
screen.
it basically gives the receivables and the payables, the
Hmm.
assets and liabilities
Hmm.
spread across different markets. So in US dollars, they are so and so, in euro, they are so and so, and that is compared against their 2024 outstanding
Hmm.
for that thing. So we definitely see that they increase their liabilities and assets with US dollar,
So this
and
is
for
this
asset,
is the sorry. So this is their receivables. Um, so you are telling me that Sun Pharma doesn't have any receivables in rupee. They don't sell anything in India. That's not true.
no. This is only with respect to foreign market. If you
Okay,
can look
understood,
at,
understood, understood. Foreign
yeah,
receivables, not the Indian receivables. Understood. Go ahead.
not Indian students, only the foreign ones.
Okay. Hmm.
And if
And
you
then
look at
and then
E130,
sorry, and then
sorry,
140,000 million rupee. This total which is here,
mm,
140,480. What percent of this of total revenue of or total receivables is foreign receivables?
what percentage of receivables is something I have to check. But the
Huh.
percentage of revenue is split, I think, between 33 and 67. 33% of the whole revenue comes from India, and 67 comes from overseas.
Then this will also be two third. Understood.
Yeah,
This will be two third only, approximately.
yeah. So yeah, if you come to E113,
Okay. Remove this E113. Okay. Yes, E113.
I have just quoted the sensitivity analysis ka data. If the
Hmm.
Indian rupee strengthens by, sorry, it has to be 5%. I don't know why it's 8. Yeah, so if it strengthens by 5%, then the profit impact is 543 crores.
Rupee has weakened by 7%. Rupee is not 92 rupees, so there's no question of rupee strengthening because of the market. So can you put negative value there? Is there a formula written there?
No. I've just quoted it. Sensitivity analysis, action
Acha, acha.
analysis, you
Okay,
look it
okay.
up.
Huh. Now you see how they paint a rosy picture, you
Huh.
know? So what if I become a billionaire overnight and become a billionaire tomorrow? That will rarely happen unless I get $1 billion in coming in from someone. Because I'm not even purchase a lottery ticket. So in saying that Indian rupee strengthens by 5% doesn't make sense. Of course, it
Because I will
hurts
never
them.
do.
Of course, it hurts them because two thirds of the money comes from abroad. So it hurts them a bit. But okay, let's see. Actually, it should they should then have a much. Actually, it's good. Indian rupee will never strengthen by more than 5%. Please go ahead.
Yeah, so this is basically their mix of business. India responsible for 33%, US 31%, very close second. Emerging markets 18%, the rest of the world is 14%.
Huh. So this is classic. So Infosys has 80% of the money coming in from Europe and US at some point of time. Now they have diversified to Australia and other countries as well. But a lot of money, literally 60 70%, still comes from the US. So they make money by selling the consultants in dollars and paying us in rupees. So a starting salary of someone in Infosys is what, 3 lakh rupees a year, 4 lakh rupees a year. If you are a fresh BTech engineer and join Infosys, it's still 3.5 lakh rupees. You will have bachelors living in a shared PG in Bengaluru and earning 3.5 lakh rupees per annum, right? So that means it's hardly 30,000 rupees a month. 30,000 rupees is about $300 a month. $300 a month. If you work for 20 days, is $15 a day. If you work for 8 hours, that's $2 an hour. Less than $2 an hour. Infosys sells them at least $20 an hour. That's how they make money. Of course, they are not always utilized. They are on bench for a long time, but that's how they make money. So in the same case here, so but if the rupee weakens, Sun Pharma benefits. And what they would have done cleverly, if you are very clever, what you can do, you can register in Nasdaq or US stock exchange, and you can take some debt directly in the US. So then your dollar is balanced with dollars. You don't need to worry about that debt in Indian currency. You don't have to disclose it here unless your headquarters are here. Anyways, go ahead. What next?
It's just basically just my conceptual understanding,
Huh.
which is at column B, the entirety of column B.
Good. So
I was basically looking into what forward contracts are, what options are, what
very good,
prices
very good.
are.
Good way of understanding this, and very good start. Understand the pharma as a market, because India provides a lot of medicines, which is finished good in terms of pharmacy, to the world at cheaper prices, and it is becoming, what percentage of Indian exports is pharmacy?
That I just
And what is the share of Apollo, of Sun Pharma is in it? Because they have Glenmark, they have
Dr. Ratings.
uh, they have
But I
Lupin.
think
They
slightly
also they
more
also
FX dependent.
so actually all the pharma companies were my clients. So Lupin is one, Glenmark is another, Cipla is third. Then you have Sun Pharma, and then you have some smaller companies. So you can look at Cipla as well. They all have plant. They are just like Infosys, Wipro, TCS, Tech Mahindra. They're all commoditized market. Almost make similar medicines, little bit change in formulations. Those who make medicines for chronic illness, they get long term value. For example, if you make medicines for diabetes or heart ailments, then people buy it for next 30 40 years. So you have a fixed payment coming in. It's like taking a Netflix subscription. So or if you make insulin, people will always buy insulin from you. It's like buying a subscription. So you always get fixed payments from your customers. That's the
Easy.
reason Novo Nordisk is very popular. So
Sorry,
you are adding a quantity of pharma to Indian exports. Yeah, how much percent? Let's see.
that's 5%.
Okay, it's
5% is what it says.
maybe it's coming up slowly on my screen. So it's 5%. It's still very much smaller. I think software, India still exports software a lot, and then India makes gems and finished gems, which is diamonds. India also makes finished petroleum goods. So that is also an export of India, going straight from Jamnagar in Reliance refinery. Those are India's largest export. India's largest imports are gold and petrol. I remember very clearly. So Indians buy a lot of gold and they put it in the household use, and Indians buy a lot of oil. Chalo, we have had good long conversation. I hope this session threw some light and on
Definitely,
the
and I think to fully understand the whole picture, I might have to watch it a couple more times.
ha
If
do
I have doubts,
yeah,
yeah,
well, yeah, I will do a separate after we have 9 and 10 coming up next, where we go ahead on the same journey of leasing. We'll try to focus on Apollo so that we understand the rubber industry a bit. But post that 10, I will have a deep dive only on options, futures, and derivatives. Will I cover whatever I'm making a note of all these options, futures, derivatives, black shoals, and everything. They are they deserve a separate session on themselves. How do you exercise the call option or put option? That will help. And the best part
I
is,
think apart from just reading the annual report and everything, and basically knowing the revenue model,
hmm,
I think we have to do some math just to see how a lesser might benefit from,
yeah,
or how a
exactly,
lesser might take these things into account when deciding to invest.
yeah. So what
I
I
mean, I assume there has to be some benchmark or a metric like how we have IRR and NPV for investment institutions, right?
correct, and those actions of lesser has to be done usually by analysts and consultants or risk management team, and that requires a lot of reading of text. It's not stored in numbers. So what I had done earlier, I had written, and in older days, people will use Excel. So what I'll do later when we do a deep dive is I have built a couple of Python scripts. I'll do a bit of refresher of Python for you, and then I'll show whatever scripts I have built, where it can ingest English and understand and highlight which portions of the annual report are aligned to their business model, or if there are any news articles related to their business practices or business models, and how
Okay.
that will impact. So, for example, if Apollo says that we are not going to buy rubber from Malaysia, we are going to buy rubber from Andhra Pradesh, from Visakhapatnam. For example, we will grow our own rubber trees. We have purchased 1,000 hectares in Visakhapatnam, and we will grow our own rubber trees, and we'll grow our own. We'll buy rubber from our own rubber trees, right? Then that's in next 10 years the trees will become large, and then we'll buy rubber from we'll take rubber from our own trees. Then what is Apollo doing?
True.
Apollo is making a vertical supply chain. They are doing vertical integration. They are integrating the entire supply chain within India. So then the dollar risk or FX risk, FX variability goes away. So for example, so then that is measured in the newspaper, but it's not there in the annual report. It will come up maybe at the end of 3 months, or it's there in the SEBI disclosures. You have to go and read up those disclosures on the screener or wherever. So those things can be pulled in by a script, and those things can be analyzed better programmatically. So if you don't have one client, if someone gives you 5 clients, so it becomes very difficult as a working professional to have data of all 5 clients every day in the morning. One thing is that what I do regularly, and what I will advocate on screen as well, is to purchase a pink
AP
paper,
subscription.
not ET, just any pink paper,
Uh, uh,
a business standard or ET or anything, or HT Mint or whatever. One is that you can do only so much, but human mind and its comprehension capabilities is limited. And second thing is you have to go and open a notebook and write those notes. What if an AI engine can parse those fields real time and give you live data at a click of a button? So you will have fresh data, not stale data, and it's there on database. It's not on piece of paper. So if paper gets lost, you are not stuck. If your diary gets misplaced, you're not stuck. It's there real time. So we'll do that kind of bit of Python refresher for a couple of sessions. Then we'll go a little bit into understanding of how Python can help you do these kind of interesting things later, right? But next session 9 and 10 will progress on this journey. Um, Thank you everyone. For anyone who is watching on YouTube, we'll stop streaming now. Join us for the session 9 next, and then I'll close it with Prashant off the stream.